Hi everyone, I'm Paul and welcome to my review of ICT's 2022 YouTube Mentorship Program for Lesson 13. Now 13 is meant to be unlucky, but in today's video we're going to be getting a bonus session on market structure because Lesson 12 had a lot of detail in it and today's video is hopefully going to help consolidate some more of that knowledge. So make sure you like and subscribe and let's jump into today's video. Today's video is a review of Lesson 13 of ICT's 2022 Mentorship Program. And in today's video, we'll be going through a market structure example using the NASDAQ from the 25th of February 2022. We'll be using the daily, hourly, 15-minute and 5-minute timeframes. And then finally, we'll wrap up today's video with some thoughts from ICT in Lesson 13 on trading in general. So we'll start with the daily chart on the NASDAQ. Now, our bias for the NASDAQ is bearish. We're expecting lower prices, but what we need to keep in mind is even in a trending market, so we have a downward trending market, is we will get the market go up periodically in those cycles. And so that's what we're looking at the moment. So the market's trended down from December late last year. You can see we've created this low here. The market's, retraced a little bit, and then we've taken this sell side liquidity out again. So even though our bias is bearish, we don't really want to be going short here. And so what we're expecting is an interim bounce or interim strength in the market. So there's a number of reasons why we're expecting higher prices. Now, remember, what we're really looking for is where is liquidity going to be drawn towards. And so in this example, there's two things that we're looking at. So we have a bearish fair value gap just here in this pink box. So we're expecting price to be drawn towards that imbalance, and price will look to, rebalance that imbalance. And we also have this order block here. So remember, in a downtrend, we have up close candles, and these act a little bit like speed bumps. And so we'd expect price to go back into these areas, these order blocks, but not breach them. And so looking on the NASDAQ, we have both a fair value gap and an order block, and we've already had this sell side liquidity taken out here. So it's reasonable to expect that price will draw towards this point before continuing lower. Now, the other thing we can do is look to other asset classes for confluence. So in this example, we can look at the S&P, so the ES, and you can see we have basically the same formation as we have on the NASDAQ. The only difference being is that the ES is leading the NASDAQ a little bit here. So you can see this up close candle here is almost into that order block and is much closer to that fair value gap. So that just builds additional confluence for our hypothesis that we're expecting higher prices. So we'd expect the NASDAQ to catch up to the ES here, so it's a little bit behind. So that just gives us more confidence in our hypothesis that price is going to draw higher. So this just gives us more confidence in our hypothesis that we're expecting higher prices and that price or liquidity is going to draw towards this particular region. So if we zoom in now to our 1 hour chart, we can start to build a little bit of a picture of what we're expecting to happen in the marketplace. So you can see above where price is at the moment, you can see we have that order block from the daily chart, and we also have that bearish fair value gap from the daily chart as well. So we're expecting price to be drawn towards those points. The other thing that we have is we have these relative equal highs here. So we know that there's buy-side liquidity resting above these levels here. So these levels would normally be seen by retail traders as resistance. And so they will have their stops behind there. They'll have their buy stops behind there. And so liquidity is naturally going to be drawn to that point and take out those stops. We also have a bullish fair value gap formed on the chart as well. So you can see we have this imbalance here, and you can see price has, quite well respected that bullish fair value gap and has traded in amongst it before going higher. The other thing we also have, and keep in mind that in an uptrend, the down close candles act as support. We've got another order block in this yellow block. So again, we're starting to build confluence. So we have a bullish fair value gap and we have an order block all residing in the same location. So this gives us additional confluence and confidence in the direction of our setup. The other thing that's worth noting is that the candle that forms part of this order block is actually an intermediate term low. So remember, an intermediate term low has a short term low either side of it. And remember, our swing low pattern is basically a 3-candle pattern with the center candle having a lower low than the candles either side of it. So you can see that here, this candle has a lower low than this candle and this candle. And in this case, we have 3 swing low patterns with the intermediate term low in between these two short-term lows. So these are higher lows than the intermediate term low. The reason that the intermediate term low is significant is if we're expecting higher prices, which we are, we're expecting a draw on liquidity to the upside up into this zone up here, then this intermediate term low, the low of this candle, should not be breached. So if this candle was breached, then our hypothesis would be incorrect. But if it isn't, then that would support our hypothesis that we're going to have higher prices. So from the 1 hour time frame, we now have an area of interest that we're looking at. And we also know from this intermediate term low where we'd be wrong or where our hypothesis would be incorrect. Zooming in further now to our 15-minute chart, we can just orientate ourselves on the chart. We can see we've got our daily targets up here. So we have that order block and we have that bearish fair value gap up here. And also from our 1 hour chart, we have this bullish fair value gap here and we have our order block. So this gives us our area of interest that we're looking to work in. And also remember that the time of day is important. So you can see this green line here marks 8:30. And so we're looking at getting set long after the open. So remember, a core part of ICT's teachings is trading in that New York time zone, so in that morning session. So remember, we have a bullish bias. We're looking for higher prices. And so one of the things we want to make sure we're doing is buying in a discount market. So if we run our fib from the low to the high, you can see we want to be trading down in this range. And so if we look into this area, this is already an area of interest for us, which we've garnered from that 1 hour chart. So we have the fair value gap, the bullish fair value gap from the 1 hour. We also have the order block. But if we also look into this zone here, you can see in this discount part of the market, we have another bullish fair value gap, which is formed above that. So again, we're just layering these fair value gaps and order blocks on each other. We're creating an area of interest, and we're also building more confluence across various time frames about where we want to be doing business and where we want to get set. So now that we have these, you can see we're overlapping these areas. We have this bullish fair value gap here, and we also have the time of day that we want to get set, and you can see that gives us this indicator here. Now, even if we'd use just the 15-minute chart as our mechanism to get set in this particular trade, you'll be able to see that it still would have been quite a good return. So assuming we'd use this bullish fair value gap as our entry, you can see that we have our 3-candle formation here with the fair value gap formed in between, and we have our time of day that we'd be looking to get set, which would be here after 8:30. So assuming that we had our limit at the top of the 2nd candle or at the bottom of that 3rd candle, we would have got set just around here, and our stop obviously would have been down here at this swing low down here. You can see we could have quite easily got over a 4-hour return. So I think that's just an interesting point of note. ICT often mentions that the 15-minute chart's the only one he needs. And certainly in a lot of the work that I've been doing, that you can find and you can get into trades on that 15-minute chart without having to go down into those lower time frames. If that's something that you don't feel comfortable with, there's plenty of opportunities on that 15-minute chart, as you can see right here. So we'll go into the 5-minute chart. Now, unfortunately, my data in TradingView doesn't go back far enough to show the 5-minute chart. So I've just taken a screenshot, and we'll just walk through, I think, some of the salient points. So what we're looking at is obviously the swing low, and this is the area of interest that we're looking at on the 15-minute chart. So this swing low from the 5-minute has traded into the bullish fair value gap and the bullish order block that we outlined in the 1 hour and 15-minute time frame. So the thing you'll notice on the chart is the orange arrow. So this up close candle has actually filled the imbalance. So there's a small fair value gap from that swing low that was created in that big up close candle. And that up close candle, which is signified by the orange arrow, has actually filled in that fair value gap. And that makes it instantly an intermediate term low. So you'll remember from the ICT teachings is when we have an intermediate term low formed, our expectation is that the low of that candle won't be breached. Now, in addition to this, we need to remember that down close candles in an uptrend will act as support. Therefore, the low of the down close candles shouldn't be breached. So we'll expect that price will retrace or draw back into those areas in an uptrend, but we won't see the low of those down close candles breached because therefore the trend would be finished. Now this is important because this has implications for how we can use stops and trailing stops. So obviously, if we have an uptrend and we have down close candles acting as speed bumps or areas of consolidation or support in that uptrend, so we can use those areas of support or the lows of those down close candles as areas where we can use stops or trailing stops so we can use these down close candles or these areas of support in an uptrend as a place where we can use to place our stops. So keep in mind that in the uptrend, we shouldn't see these down close candles lows be breached, otherwise the trend will be over. That's where we can place our stop. So it makes obviously perfect sense. If we're expecting the trend to continue, our stops would not be breached. But if the trend was over and therefore we'd be expecting lower prices, our stop would be triggered and that would protect the profit or the risk on our trade. So in this particular trade example, ICT takes 3 trades in total, and he actually pyramids his entry into the trade. He has the most contracts on his first trade, and then the last trade, the third trade, is where he has the least number of contracts. And he takes 100% of his profits at his target. And you can see those trades are denoted on that screenshot with the little blue arrows. They're his entries, and then the red arrow is his exit. So they're the candles that he gets in and out on. The logic behind scaling into a trade like this is that you create a better foundation for your trade. So it's one trade, but with 3 entries or 3 sub trades, if you want to think about it like that. And so obviously building the trade in this manner, so you have more of your contracts or a greater portion of your risk on that first trade, you can then use the positive equity on that trade to your advantage. Whereas if you do the reverse, you don't allow any buffer in your position if the trade goes against you for a short period of time. So in this example, ICT takes 1 trade with 3 entries and 1 exit for a 21% return. So we'll finish off today's video with some of ICT's thoughts that he shared in lesson 13 on his just general thoughts on trading and how new traders should look at their trading and how they should progress from, a new trader into a trader that's trading with live funds. So the trap for the majority of new traders is to rush into live trading too quickly. And most new traders don't put enough time into their back testing or forward testing, and they haven't been consistent with a demo account for at least 6 months. And as a result, they're not indifferent to the outcome of their trade. So they're not desensitized to the outcome. And whenever they're in a trade or they're trading, it makes them extremely nervous and agitated, and even, to the point of making them physically sick. New traders also don't have a solid trading plan, and they've not spent enough time working on their model. So that's obviously what the back testing and forward testing and time in a demo account does, is it not only gets you the ability to refine your trading plan, but it also allows you to spend more time on it so you really know it inside and out. And what most new traders do is they just get into a trade and then they figure everything else out later. So where their targets are, where their risk is, all of that sort of thing is done post-trade rather than pre-trade. And from a behavior perspective, most new traders will tend to overtrade. I think lots of us have done this in our past, so they trade way too much. And then also the mindset is that every trade has to be hit out of the park. They need to make the maximum return on every trade. And this often leads to letting profitable trades turn into, losing trades. So the net effect of all of these points is that new traders are effectively treating trading like gambling. It really is just a hit and hope methodology, and their success will really just come down to chance. And this is obviously the reason why, 80% of new traders fail in the marketplace and end up blowing up their accounts. So what can we take from new traders and what can we incorporate into our trading journey to make sure that we become successful traders? The first thing is that we have to front load the work and invest the time in back testing, forward testing, and trading in a demo account. Developing a robust trading plan which has goals for the day, the week, the month, and the year is critical and should be something that all traders have. We need to recognize that we don't need to be trading all the time. Once we've hit our goals, it's fine to step away from the market. Like ICT does, you can use a demo account if you want to keep, scratching that itch, but you don't need to dull your edge and you don't need to give that money back to the market. Successful traders leverage their power of consistency and compounding. So a 20% a month return can quickly become a substantial sum. Trading, like so many other things, is a marathon, not a sprint. And finally, we need to treat trading like a business. And just like any business, it takes time, it takes planning, it takes reinvestment, and it takes, continuous improvement to be successful over a long period of time. So there you go. There's my review of lesson 13 of ICT's 2022 YouTube mentorship program. I hope this video helped consolidate a little bit of your understanding around market structure and also made you have a bit of a think about where you are in your trading journey as well. So from my perspective, I'm in the process of building my own short-term trading system based on some of ICT's teachings. And so being reminded of some of these points periodically is helpful because, like so many other things in life, is the more work you do up front, the easier it is later on. And I don't think trading, and certainly building a trading system, is any different. So if you enjoyed today's video, it would be great if you could like it. That helps other people to find it. And if you enjoyed today's video and you'd like to see others like it, make sure you subscribe to my channel and click on notifications. Thanks for watching, and I'll see you on the next video.